Now we've really seen that shift over the past 12 to 18 months. And July 2023 to July 2024, Texas is plus 85,000 and Florida is plus 64,000. So Florida going from growing its 300,000 net basis, net domestic to 64,000, and Texas going from 222,000 to 85,000 net basis. So the migration shift, that deceleration, what that means is that local incomes are now relied upon more to support where prices got to during the pandemic boom. And in places like Florida and pockets of Texas, price growth was even higher there than the rest of the country.
This is going to be a very well-timed conversation because last I checked, everybody owns a home for the most part or rents. This is going to be an exciting conversation with Lance Lambert, who I've had on Spaces in the past and is now joining us here at the High Conviction Podcast by Granite Shares. My name is Michael Gayed. This is the High Conviction Podcast by Granite Shares. Joining me is my friend and co-host, Mr. Will Rind. Will?
Yes, thank you, everybody. Great to be doing this today. Thank you, Lance, for coming on. Looking forward to this conversation. My name is Will Rind, founder and CEO of Granite Shares. We're a ETF asset manager based out of New York.
And of course, Mr. Lance Lambert, who's been in this field on the housing side for some time. Introduce yourself, Lance, for those who are not familiar with your background.
Yeah. My name's Lance Lambert. I'm the co-founder and editor-in-chief of Resi Club. Resi Club is a niche news and research firm focused on the U.S. housing market. So really covering what's going on down to a regional and local level across the entire country, looking at the buyer and seller dynamics. How is inventory moving? How is prices moving? And then we also track different sectors like build to rent, single family rentals, home building, the mortgage sector. And our audience is a lot of home builders, real estate agents, loan officers, people who deploy capital into the space, and a lot of single family investors as well. And my background, 10 years as a data journalist. I've worked at places like Bloomberg, Realtor.com. I was last the real estate editor at Fortune Magazine over the past 4 years. And I jumped ship back in October 2023 to launch Resi Club.
So I'll start off just because you mentioned that word niche. What does mainstream media, what do mainstream journalists get wrong about housing that maybe you get right?
Yeah. So, the way that like the stock market is covered, and you hear a lot about like what the S&P 500 is doing, you can buy the S&P 500, right? You can buy that aggregation of those 500 stocks. U.S. home prices, U.S. housing market, those are aggregations of the market, but they're really a broad brush. And if you dig in deeper, there's a lot of variation happening in the housing market. And that's not just, a lot of variation today, but there's always a lot of variation, right? Even during the pandemic housing boom, I knew people, and I was tracking data in like Hoboken that were really struggling to sell their home. And while you were reading about places, going up 30, 40% within 12 months. And so I think that's probably the biggest thing. And that's why in my reporting, when I talk about like what the Case-Shiller's doing, I like to point out that it's, nationally aggregated single family home prices, for repeat sales. So I think little things like that are probably the biggest areas where, the media probably gets it wrong. And I think at other times, just kind of understanding what the housing sector and these different pieces and how things work and how to get good data, that's probably where the media falls short the most.
Maybe, Lance, we can start with just a kind of your outlook for housing, particularly for this year. And I still say that because a couple of interesting things are happening that everybody knows that the Fed has started to cut interest rates, and we're on this what seems like an interest rate cutting cycle. But yet, I saw a piece that you put out that said actually, with yields going up, the 30-year mortgage is now higher than it was at this point last year, which I thought was pretty interesting. So maybe talk about what you think or what your outlook is for housing, and then clearly the mortgage market as well.
With the housing market, one of the things about housing that's historically true, and this is statistically true as well for housing, is that every year is usually most similar from a historical basis to the year prior. Housing moves very slow. So where we were in 2024, and really a lot of 2023, is a market that is very constrained. It's constrained because there's a lack of affordability. We saw a historic deterioration in affordability back in the second half of 2022, and really during the pandemic housing boom, with the overheating in prices, then the mortgage rate shock going from 3% to 7%. And then a lot of these carrying costs of housing have slowly started to move up. So there's an echo of the pandemic housing boom still going on. It's happening in home insurance because the replacement costs have gone up so much. And it's happening in property taxes as municipalities, where they have the power to do so, are trying to catch up. And so that affordability squeeze. But then on the other side of the market, the actives and that supply-demand equilibrium back in 2023, and sorry, my kids are yelling in the background. They should go downstairs. Is still the supply-demand equilibrium and the active listings is still in a place where it's putting upward pressure on prices nationally, has been where it's been. Now, we've slowly seen that tug of war shift, where in 2024, we finally saw active listings start to rise, right? As, that constrained demand, the demand was constrained. And finally, as new listings started to tick up just a little bit, those homes were not absorbed. And so active listings rose. And so active listings are up around 30% nationally year over year, and up about 150, 200,000 listings year over year. And so heading into 2024, we're still in an environment where the affordability is constrained. It's not necessarily the shock of it, because the shock is back in 2022. People kind of accepted that rates are not necessarily going down a lot, but there's still an affordability pressure. And then on the other side of it, actives are now in a place where they're higher, but still for most markets, not that high relative to recent history for those markets.
Well, just sorry, 2 seconds. With the inventory increase, do you put that down to the fact that rates for a period of time were starting to drop and people were thinking that the market's going to ease up?
No, I consider the active inventory rise mostly driven by the fact that there's a lot of suppressed housing demand, and it's really demand driven. And so as those homes take a little longer to sell, not everything's getting absorbed as fast as it comes onto the market as it was prior, actives begin to build. Now, another big part of the story for the active inventory is what's happening in a lot of the Sun Belt and Southeast, Southwest, some of these Mountain West markets that were huge boom towns during the pandemic boom. And so in those places, what's occurred is that there's been a significant deceleration in migration.
I think it's interesting because there's this, actually that was a really interesting question that Will put out about the point about the expectations for lower rates. But if you have active listings picking up and mortgage rates picking up. That seems like a very nasty setup. But we can get into that. Here you go.
This will be a little dated. I have my new data actually going out today for this. But where we are is a place where the Southeast, the Southwest, some of these Mountain West markets, they've shot back above pre-pandemic levels for active inventory. And a lot of the Northeast and Midwest has stayed fairly tight. And so what's driven this here is that we've seen a shift in a few different things. But the first, let's go over migration. We've seen a deceleration in migration to places in a lot of these Sunbelt areas, in particular, Florida and Texas. So here's what happened in migration year over year for net domestic migration in 2021. So summer of 2020 to summer 2021, Florida saw 247,000 people on a net basis move in. Texas was 196. The next year, Florida was 314,000 and Texas was 222,000. Then in between summer 2022 and summer 2023, it's still staying fairly high, 191 for Texas, 185 for Florida. Now, we've really seen that shift over the past 12 to 18 months. And July 2023 to July 2024, Texas is plus 85,000 and Florida is plus 64,000. So Florida going from growing its 300,000 net basis, net domestic to 64,000, and Texas going from 222,000 to 85,000 net basis. So the migration shift, that deceleration, what that means is that local incomes are now relied upon more to support where prices got to during the pandemic boom. And in places like Florida and pockets of Texas, price growth was even higher there than the rest of the country. I could show you Punta Gorda real fast just to give you show you what's going on. So Punta Gorda, for example, they saw home prices move up 73% during the pandemic boom. With this,
for the uninitiated, where's Punta Gorda?
It is in Southwest Florida, kind of near Cape Coral, south of Tampa.
Okay.
And the U.S. during that same period saw prices move up at about 40%. Now, with everything that's gone on, this deceleration of migration, the fact that fundamentals there are more stretched, the fact that, and I'll get into this in a second, the fact that the dynamics in the home building sector as well, you've seen prices actually come down and correct a bit in Punta Gorda, for example. And so the first factor here is this deceleration of migration. The second is the strained fundamentals. And then the third thing at play is that a lot of these Sunbelt markets have a lot more single family construction. And let me show Punta Gorda, for example. So Punta Gorda is a market with 200,000 residents in the metro. Pittsburgh has 2.4 million. But Punta Gorda during the pandemic boom was doing more single family permits than a market like Pittsburgh 10 times its size. And so with this shift in migration, the shift in housing demand, as builders adjust to that environment, they do things like mortgage rate buydowns, these affordability adjustments to meet the market when and where needed. And so as that occurs, it draws the attention of buyers in the resale and existing market who would have otherwise wanted to buy an older home, wanted to buy something in the existing resale market. But because the builders are doing affordability adjustments and these existing home sellers are, they're sticking to their price. They're not coming down much. They're not doing as much, paying for the points, seller commissions. And so because of that, it's drawing the attention of the buyers to the new construction market. And so the existing and resale market is taking longer to sell. And so that active inventory begins to build. And so that's why we have such a bifurcation in the country right now, is because of the migration patterns have shifted a bit as people have, work from home is not necessarily 5 days now. It's a little more hybrid for most people. And so with that, the fact that some of these markets got more strained and saw more price growth during the pandemic boom, and then these varying levels of new construction where the Midwest and Northeast just does not have much of that product that has to get moved, and the Sunbelt and Mountain West does, has created that bifurcation.
Can I ask you, and this is actually related to a question that I'm seeing in the chat here, asking about how will insurance companies' policies play into this year's market? I mean, part of this is not just migration. It's also just, I've seen all kinds of headlines around home insurance rates are driving people out of neighborhood, right? And that's not really, that's as downward sticky as it gets.
So here's what's going on with insurance across the country. We've seen a shock occurring over the past 24 to 36 months. It's been most acute over the past 12. And a lot of it is driven by replacement cost. The fact that now it costs a lot more to replace homes if they're damaged, and home prices have went up so much. The cost of construction, labor, all of that overheated significantly during the pandemic. But it's been felt most acutely in places like Louisiana and Florida. California kind of has a bit of the opposite problem where it needs to be felt more, but the insurance market, the insurance commissioner there has kind of fought a lot of these increases. And so a lot of, the insurance firms have just left the state. Now that's still a problem in some places like Louisiana as well, but it's made it to where California hasn't necessarily felt the premium increases that it otherwise would have. But the 6 main drivers here for insurance, and this comes from CoreLogic's Chief Data and Analytics Officer, John Rogers. If you're really into understanding the home insurance market, I'd recommend following him on LinkedIn. CoreLogic is unique in that his team, he has like 200 data scientists, meteorologists analyzing real estate data for climate and insurance risk. And a lot of the insurance companies buy CoreLogic's data for this to input into their risk models. And so the biggest drivers for home insurance right now are natural disaster being one of the big components. Losses are up 53% over the past 10 years. A part of that is also that we are building more in the places that have the most natural risk frequency and risk profile. Another part is going back to that, the risk concentration into those natural disaster areas. Third being construction cost. Replacement cost increased 44% since the start of the pandemic. And this chart's a few months old, so that's probably like 46 now. State regulations have caused a retreat in some of the high risk areas. The state lender of last resort, or in the reinsurance costs, I don't want to get into those two as much. But so the insurance market is seeing a secular upward pressure from some of this disaster risk stuff. And then also the echo wave, the echo pandemic housing boom as the market tries to catch up to that overheating. And so while prices and rates moving up a lot affect mostly buyers, investors and buyers trying to buy homes, insurance is unique in that it hits everybody, right? It's a carrying cost. So I know, one of the biggest chunks of my audience is single family landlords. And for them, this is their number one concern. 76% of them are very concerned about what's happening to home insurance. Because these hits that come from home insurance, that's an immediate attack on their cash flow if they can't pass that on to renters. And this is a harder environment to raise rents right now. So home insurance is definitely a really big story for 2025.
So given we're, hopefully at the end, but we just went through that horrific fires, I should say, in LA, where I guess home insurance, one of the key issues that has been front and center. What is the end game, do you think, for home insurance? So we know that, major lenders, like you said, pulled out of the California market and some of these particular markets that have been affected by the wildfires. But are we sort of moving to a place, or maybe are we there already, where there'll be certain parts of the country where you cannot get any kind of home insurance, or you'll be able to get it, but at just a price?
So I'm going to be a little hesitant to make really big predictions, but I do think that home insurance is going to become a very hot political story. Because one, housing affordability is so strained. That's being the first one. The second one is homeowners have a tremendous amount of political power. And the third is you're starting to get into a place where with these, different events, there's a lot of people who are in the cracks, right? So not covered. Think about the people in East Tennessee, right? Some of the people in North Carolina that were hit by Hurricane Helene, and then Hurricane Milton down in Florida. And they weren't covered. Some of them didn't have flood insurance. It was a very small percentage of people in North Carolina and Tennessee that had it. And then you go over and you look at what just happened with these fires in the Los Angeles market, right? And a lot of these people didn't have insurance. And so I don't know where it's going to go. But I think there will be I think politics will get involved. And I do kind of look back to what occurred in the health insurance market back in Obama's first term, when they were trying to cover people with pre-existing conditions. And I think the pre-existing conditions for healthcare, I think, is going to run even more over the next few years as more people lose access to home insurance. As these home insurers, if states don't allow them to pass on some of the risk, and as some of these home insurance firms try to, pull away from some of these very risky areas.
I wonder how policies around immigration and deportation will impact the housing market. I hear a lot of smart people make the case that that's one way to solve shortages. What are your thoughts on that?
Yeah, with immigration, I think it's a really big wild card, right? Because it's something that we don't really know where we're going to go, right? And you have to do a lot of guessing. So anything that I give on this is going to be a lot of speculation, but that's really just because we're in a place where we don't really know, right? What exactly it will look like. Now, I will say that over the past few years, we do know that the increases in immigration that were really from, the undocumented side, right? We saw a huge burst in 2022, 2021, into 2023. And what that did is that put upward pressure on the rental market. Now, it wasn't the driver of, this overheating for rents. That's a much bigger story. You have to zoom out and look at the pandemic effects. You have to look at the stimulus. You have to look at the monetary policy, all of those pieces, right? For the overheating, both for housing, for the purchase market, for home prices, and for the rental market. But what it did is that during a period when the rental market was vulnerable, as rates moved up and as that cycle of overheating really rolled over, it really buffered rents from falling more than they otherwise could have, is my view. On the multifamily side is that multifamily, a lot of multifamily supply that was financed during very ultra low rates back in, 2020, 2021 into 2022, as that came into the market. And so heading forward, if there is a big downshift in the levels of, illegal undocumented immigration into the country, you would most likely, it would be not necessarily that it would make rents fall for multifamily, but it would be downward pressure in some particular parts of the country, right? And then the second thing there is, if you were to see a lot of deportation out of the country. And this is where I'm the most skeptical, because during the past administration, while we saw a deceleration in some of the undocumented immigration, we didn't necessarily see a huge level of deportations, right? And so I'm a little more skeptical here in terms of like how much we go down the hypothetical rabbit hole. But if you were to see a lot of deportations, that would, of course, on one side, take away some demand, most likely for certain parts of the rental market. On the other side, if it was very big deportations and it's kind of broad brush, you could potentially be deporting some of the labor side for the construction market, right? And I think that would be some of the fear for the builders. And then outside of that, I think those are the biggest things. Now, let's say it's really big, the deportations, right? What could occur then is if you're in a market where you go max that direction, it starts to become less of like the immediate hits to housing, like the labor hit to housing for the construction market, less of a hit from, actually deporting these people and that being less rental demand. And then it becomes a question of what happens to the overall macro economy, right? If that macro economy then were to soften more, right? And we start to see long-term yields and mortgage rates come down, that has a different type of effect for housing, right? And so it becomes a hard thing to kind of map out because there is so much hypotheticals. And then if it is really big, it could have a broader impact on the economy, which then circles back to have an impact on borrowing costs.
Well, I want to so maybe expand on this idea because talking about insurance and it becoming a political issue in many ways is perhaps not as acute here, although it is, I would say, a deeply political issue in many places around this idea of housing affordability. But if you look at Europe and certainly parts of Europe, the UK, for example, I'd say this is almost like the number one political issue is what they call the housing crisis. And I say that because regardless of who's in power, the solution or the only solution that seems to be ever put forward by government is to build more houses. Now, it always struck me as, again, being slightly odd that that's the solution that is sort of always, I guess maybe it's the easiest thing to say, much harder to implement in practice. But in your mind, I know it's a big question, but what are the potential solutions to the kind of housing crisis?
Yeah. So some interesting people that I would recommend, or somebody interesting that I would recommend people to go follow if you want to kind of go more down this rabbit hole, and especially in a different direction that's necessarily being talked about, is a guy named Kevin Erdman. He's written a few books on this. His view, and I think it's very interesting because I see some of it in the historical data that I look at. One of his big arguments for the US market is that during the crisis of the 2008, 2009, 2010, in his view, we over-tightened lending standards. So you have a lot of people run around and, kind of cheer about the fact that people in the US who are buying homes have very high credit scores, right? And, people even say pristine credit, right? And kind of, talking about how the fact that the market is just so much healthier today. Well, Kevin's view is that what we essentially did is we took the very bottom of the market and not just the people who were, let into the market during the ninja loan period, right? During the shady loans. But we actually went above that and we took out a whole group of people who historically had access to mortgages in the US, and we just chopped them out. And we not only chopped them out, we chopped them out of the market at one of the worst moments, which is 2008, 2009, 2010, right when the market was down. And so because of that, what we did, and that was felt most acutely at the bottom price points, right, of the market. What we did is to single family home builders, we took away their buyers, right? We just snatched them away. And so if you look at single family home building in the US, we not only had what was probably a needed correction, we had an overcorrection in the market, and we just went too low. And so because of that, we had a real deficit, in my view, of single family housing, entry level, right? In many parts of the country. And as the economy warmed back up slowly and, confidence for housing was restored, that part of the market was down, right? And so what we saw occur in the US over the past decade, and this is still continuing to heat up more, is you've seen more institutional capital come into the market, right? Those single family homes at that entry level side, they have much better yields for investors today in this market, where there's been less of this building for it. There's less competition from this particular type of buyer. And so it makes a lot more sense for the institutional capital to deploy into the space. And so Kevin's view is that, long-term build to rent has a lot of runway because of this, right? Especially for entry-level single-family housing. Now, his view is that he would like to see it restored back to the, prior lending standards, and to allow more of these buyers from that group to come into the market and, take us back to where we used to be. Now, that would be a demand shock, right? Because it, adds more demand into this market, which doesn't necessarily in a lot of places have enough supply in terms of active supply in the market. But long-term, his view is that would help to restore us. But, when you zoom out and you look at a lot of the discussion in housing, it is very like, hey, let's just add more homes. Let's add more homes. And maybe that is the only lever that, we can kind of pull. But when you zoom out at it, housing moves very slow, right? And a lot of the solutions discussed aren't necessarily going to move the needle much, right? Like, we have this very strained affordability. And in a lot of these very expensive developed countries, it's probably going to be a prolonged thing, right? Like housing in a lot of these countries is going to be a political issue, not just today, but for a very long time. And a part of that, is because maybe some of it is the housing stock part, right? But that, you can only move that a very small percentage over time, right? And then another part is, maybe, what we kind of experienced on the monetary and fiscal side during the pandemic, right? Where, let's say the supply is the big issue in the market, right? Let's say that is the case. Well, then was it smart that during the, pandemic period, all of our levers to heat up and, kind of rescue the economies of the developed world put upward pressure on home prices, put upward, added to housing demand. So we're in a place where, entering the pandemic on a historical basis, we didn't have much active supply for sale. And then during the pandemic, we saw housing demand skyrocket as we had ultra low rates, a lot of the stimulus. We had the work from home effect, which the work from home effect was not just arbitrage of work from home where somebody lives in New York and they go and, buy in Austin. It was also the fact that a lot of people who even stayed in those cities, they wanted more space, right? They were sick of being with their roommate. They decoupled. There was a net add for demand for housing space. And so that occurs during the period of ultra low rates, of all the stimulus, as prices overheated and and rents overheated, that drove in more investors. And so the Federal Reserve estimates that during the pandemic, the first year and a half, new construction housing starts would have needed to increase 300% to match the increase in housing demand. That's just not possible, right? New home construction cannot increase 50%, let alone 300%. And so the thing about housing, and I know I'm long-winded here, but the thing about housing is that demand is more elastic than supply, right? Demand can move very quickly in a very short period. And so all of the levers from a policy perspective during the pandemic added to housing demand, and it's very elastic. And so we saw a huge overheating. And so, it could be that, supply is the biggest issue in housing, but it also, we have to be cognizant of the fact that from a policy perspective, we continue to do things that put upward pressure on the part of housing in the short term that is the most elastic, which is housing demand.
Is there an infrastructure play here where one thing I never really hear getting talked about is, can government improve, or should they be working on improving infrastructure so that we can bring, more parts of at least suburban areas to big cities into play? Like, for example, where I am in Connecticut, I'm 40 miles into Grand Central Station, and it takes an hour on the train. Now, that to me is absurd that it's so slow. And if that was 30 minutes, and then obviously the knock-on effect is you bring a lot more parts of the country into play as being commutable, and thereby you're addressing part of that issue by better infrastructure. But I don't really hear that being talked about as a potential solution.
Yeah. So the greatest resource we probably have in the US is just land. We have a tremendous amount of it. But one of the ironies is one of the biggest areas of upward pressure on housing right now is land prices, right? We don't have a lot of it necessarily ready to be, developed, right? Entitled land that is ready to roll. And a part of it is exactly what you mentioned, right? Which is it's not necessarily in the ideal places for development. And we're not doing the things to make it more ideal. Now, one thing that we did see during the pandemic is that, and we're still seeing this now today, is that the deep exurbs have gotten hotter, right? Connecticut, where you live, and a lot of parts of New Jersey, of the data that I collect, those are actually the hottest markets in the country right now. And a big part of the reason is that people now can commute into the office maybe 1 to 2 days a week instead of 4 or 5 days, right? And so what that does is that alone actually was a net improvement, not to housing affordability, but to housing, right? Because it opened up more housing that people could potentially, right, buy and be within commutable distance. Because at the end of the day, and the reason I love metropolitan areas, I know a lot of people don't like the definition of it because they like the city definition, right? But metros, at the end of the day, it's based on and calculated by commuting patterns. So it's distance from housing market to job market, right? A metro is just job market and housing market. And the sprawl of those housing markets got bigger during this pandemic period with not just the remote work, but the hybrid work, where the bounds of the New York market, for example, went further out. Now, that's good for the workers of the New York Metro, right? They now have more options, right? It's not necessarily good for the people who lived in those places, right? Because now there's more unlocked housing demand that can come into them. But I do think that for some of those areas, and maybe New York's not the best example, maybe some parts of like the Atlanta Metro and some other areas, that has unlocked more land that can be developed, right? You can build more deep exurbs. But I do think that your point there, that we could get creative and we could unlock even more, I think is spot on. And nobody's talking about that.
We only have a couple minutes, but since this is the High Conviction podcast by Granite Chairs, we always like to end off by asking the question to our guests: what is your highest conviction?
In terms of like what I believe the most?
Yeah, in terms of how things play out this year broadly for housing, or maybe specifically for some.
Yeah. So the thing that I probably feel the most comfortable is that I think the existing side of the market, even if it were to tick up a little bit, I think it's still going to be constrained. And so right now, we have around 4.2 million existing home sales in the country occurring. Before the pandemic, we were at a consistent like 5.3 million. So right now we're missing about 1 million existing home sales per year. And a lot of that is because the switching cost in housing have gotten so high so quickly, right? When you have mortgage rates go from 3% to 7%, and then you have the fact that incomes just were not able to match that swing up, a lot of people who would like to sell their house and go buy something else are not doing it. And so, the word for the existing market when a home, gets sold is turnover, right? I have another term within housing turnover. I call it churn. So it's somebody who buys and then or sells their home and then buys something else. And that is the piece of the market that is still very much missing to a degree, at least missing relative to where we were before because of these high switching costs. And so among the 16 forecasts that I track for the resale market, the average forecast expects existing home sales to be 4.22 million in 2025. And last month, on a seasonally adjusted annualized basis, we were like 4.16, I think, or 4.15. So that would be a teeny tiny increase, but not a significant change. And so it could be that existing home sales come up a bit. Maybe this lock-in effect that I'm talking about here eases a little bit as people's incomes rise, as, lifestyle circumstances change. Maybe they have more kids. Maybe their wife is unhappy that they don't have more space in the house because they do have more kids. And so the psychological side of switching costs, because switching costs are both financial and psychological. If that psychological cost starts to get a little higher, as maybe they're a little unhappier, that starts to weigh down the financial side. So maybe the lock-in effect could ease a little bit, but it's still going to be very much a play in 2025. We're still going to be at constrained levels of existing home sales.
That's perfect. I think that's a great place to end this conversation. Will, any closing thoughts on your end?
No, I think, again, Lance, thank you very much for coming on. Great to chat with you. It's been a good conversation. And we'll see how things play out.
Yeah. And the last thing I was just going to tout is Resi Club. If people want to sign up for my free newsletter, they could go to resiclubanalytics.com and then just type in their email. I send out several articles a week interviewing executives across the space. Really, my work is known for data visualization, so visualizing a lot of data. And then I also have a premium product, Resi Club Pro, where I do a monthly webinar. And that's where they really get access to a lot of my data and analysis down to a regional and zip code level for inventory and prices.
Appreciate it, Lance. And thank everybody for watching. We'll see you all in the next episode of the High Conviction Podcast by Granite Shares. Cheers, buddy.